In modern macroeconomic theory, the instruction manual is highly predictable. When an economy suddenly bleeds jobs, the central bank steps in, cuts interest rates, and floods the system with credit to stimulate growth. In February 2026, the United States labor market cracked. The economy abruptly shed 92,000 non-farm payroll jobs. Worse, the Bureau of Labor Statistics wiped out another 69,000 previously assumed jobs via downward revisions. Faced with a suddenly fracturing labor market, the Federal Reserve met in mid-March. Instead of deploying a rescue package, they held the federal funds rate steady in a restrictive range of 3.50% to 3.75%. A sudden geopolitical disruption has ignited entrenched inflationary pressures simultaneously alongside the deteriorating job market. This specific combination breaks the traditional policy mechanism. The Fed is deliberately choosing to tolerate increasing labor friction to suppress energy-driven inflation, leaving the corporate sector to navigate a severe contraction without a cheap credit safety net. This regime shift immediately invalidates the playbooks established over the previous decade. The zero interest rate policy, a prolonged economic condition where central banks anchored borrowing costs near 0%, created broad, flawed assumptions in global finance. For institutional allocators, the bedrock 60-40 portfolio is failing. The 60-40 is an allocation strategy dividing capital into 60% equities and 40% bonds. Historically, bonds rose when equities fell. Today, because supply shock inflation forces the Fed to maintain high rates, long-duration government bonds are selling off right alongside the stock market. For chief financial officers, the standard strategy of simply kicking the can and extending the maturity of corporate debt is now mathematically destructive. Extending loans into an interest rate environment double that of origination levels ensures severe margin compression. Surviving the 2026 shock requires corporate finance leaders and investors to immediately abandon the pursuit of top-line growth at all costs, pivoting instead toward radical liquidity preservation and capital discipline. The immediate catalyst for this global repricing lies in the Persian Gulf. By late February 2026, intense military escalation effectively closed the Strait of Hormuz. At its narrowest, this passage is merely 21 miles wide. Yet, in peacetime, it facilitates the transit of 20% of total global petroleum liquids and a massive share of the world's liquefied natural gas. Following the escalation, vessel tracking data revealed a near-total collapse of the maritime energy network. Commercial traffic plummeted from an average of 135 daily crossings down to just 2.6. The International Energy Agency coordinated a record 400 million barrel emergency reserve release to stabilize spot prices. However, reserve releases and overland pipeline diversions can only replace roughly 25% of the missing transit volume, leaving a massive structural deficit. The disruption cascades directly into global agriculture. The Middle East dominates the export of vital crop nutrients, accounting for nearly 50% of the world's urea and 45% of its sulfur. With these critical exports trapped behind the blockade, agricultural input costs exploded. In the United States, prices for nitrogen-based fertilizers immediately spiked past $900 per ton. The inability to secure affordable fertilizer establishes an elevated baseline for food inflation that persists well beyond any military ceasefire. This forces the Federal Reserve to maintain restrictive rates until the global supply network is physically reconstructed. The energy blockade exposes a fragile secondary dependency in the advanced technology sector. The Asian semiconductor industry is intricately reliant on imported Middle Eastern fossil fuels. Microchip fabrication is an extraordinarily energy-intensive process. Cleanroom facilities require uninterrupted, stable baseline electricity to operate without catastrophic manufacturing failures. Foundries in Taiwan, which produce 90% of the world's most advanced chips, source nearly a third of their liquefied natural gas directly from Qatar, routing straight through the blockaded Strait of Hormuz. Institutional investors rapidly priced in the magnitude of this constraint. In early March, the tech-weighted South Korean stock market plunged a staggering 18% in just 4 trading days, erasing over $500 billion in market value. A physical energy blockade in the Persian Gulf translates mathematically into a production stall for the hardware required to sustain the global artificial intelligence and technology infrastructure build-out. While geopolitical supply shocks dominate daily headlines, the most acute risk to the global economy is buried deep within corporate balance sheets, the historic maturity wall. This chart shows the volume of institutional debt coming due. By the end of 2026, up to $1.8 trillion in commercial real estate loans will reach maturity, coinciding with a corporate debt pipeline swiftly rising toward a $3.02 trillion peak by 2028. Many of the notes reaching maturity in 2026 were issued between 2020 and 2021, with highly favorable coupon rates near 2.5%. Today, those exact same companies must refinance their obligations at rates between 6.8% and 8.2%. When the cost of debt abruptly doubles, the weighted average cost of capital explodes upward. Finance committees use this metric to set their internal hurdle rates. The internal rate of return, or IRR, represents the minimum acceptable profit percentage required to justify a new project. Across the mid-cap market, projects failing to clear a newly elevated 12% IRR threshold are being immediately shelved. This forces a systemic freeze on capital expenditures. Corporations halt factory modernization and scrap hiring plans entirely, directly causing the severe employment contraction seen in the macroeconomic data. With traditional refinancing pathways mathematically blocked by 8% yields, private equity sponsors have turned the syndicated credit markets into a legal battlefield. The defining strategy of the 2026 restructuring wave is the liability management exercise, or LME. These are sophisticated legal maneuvers designed to prioritize operational liquidity and equity retention by explicitly undermining existing creditors. Distressed borrowers are executing drop-downs. They utilize structural loopholes to transfer valuable intellectual property out of the reach of secured lenders, using those assets as pristine collateral for fresh prime-rate debt. Sponsors deploy deal-away coercion. They divide lender syndicates, offering highly preferential terms to a minority group of creditors in exchange for fresh liquidity, effectively stripping covenants from the holdout majority. Entities are actively bifurcated into a clean good co for lucrative mergers, stranding the legacy debt in a hollowed-out remain co destined for inevitable restructuring. The historical assumption of lender solidarity has collapsed. Corporate survival now dictates legally cannibalizing your own capital structure to secure financial runway. Operating a corporation in a stagflationary shock demands immediate financial fortitude. CFOs are abandoning the outdated framework of top-line growth at all costs. Historically, firms optimize their cash conversion cycle by delaying supplier payments. Today, efficient companies intentionally lengthen cycles, issuing premium upfront deposits to secure scarce materials. Amidst blockaded straits, guaranteeing physical supply continuity takes absolute precedence over generating marginal interest. To manage these elevated logistics and insurance costs, CFOs deploy dynamic pricing power. Delaying necessary price hikes out of fear of losing market share guarantees irreversible margin destruction. Expediting cash outflows to build a fortified supply chain moat allows companies to meet end market demand, capturing market share while their competitors suffer maritime stockouts. Amidst the widespread corporate austerity and frozen capital expenditures, there is one critical exception: aggressive capital investment in artificial intelligence. Finance committees in 2026 utilize AI as a structural deflationary tool, prioritizing projects that offset the soaring costs of human labor and energy. Corporations heavily target this capital toward the elimination of high-friction SG&A expenses. SG&A refers to selling, general, and administrative expenses, the heavy overhead costs of running a business not directly tied to production. Finance teams are replacing these layers with automated forecasting and anomaly detection. By systematically replacing human capital costs with highly scalable compute costs, CFOs establish the operational leverage required to maintain profitability even as real GDP growth slows. For institutional allocators and multi-asset portfolio managers, the 2026 regime invalidates the primary correlation models of modern portfolio theory. The 60-40 equity bond hedge operates on the premise that when equities fall, central banks cut rates, sending bond prices up to cushion the portfolio, regardless of decelerating economic growth. In the aftermath of the Hormuz closure, the U.S. 10-year Treasury yield spiked to 4.27%. Both government bonds and equities sold off sharply together, failing to provide a reliable flight to safety. To protect capital, allocators execute mandatory defensive rotations away from long-duration bonds and directly into real assets, physical commodities, and defensive energy equities. Income investors pivot toward ultra-short duration fixed income, utilizing vehicles like 0 to 1 year Treasury ETFs. These capture yields near 4% without the principal destruction associated with long-term bonds in a rising yield environment. Geographically, multi-asset investors aggressively underweight emerging markets and Asian manufacturing hubs vulnerable to imported energy costs. They favor the United States because its status as a net petroleum exporter structurally shields its corporate sector from the worst effects of the blockade. The mathematical realities of the 2026 financial landscape dictate severe consequences. Only organizations enforcing radical capital discipline and adapting their structural agility to these strict constraints will emerge from the shock with their market share intact.